It's official. Russia has just doubled their key rate to 20%. And with Australia's interest rates predicted to rise, combined with inflation now upon us, does this mean that the Australian interest rates are about to spiral out of control in the same way as Russia? Or is Australia in a different predicament? Stay tuned and find out. Right now, there's just so much going wrong, from floods to wars to school closures to COVID. It seems like there's just nothing going to plan. And topping it all off, we can see that the Australian net debt is set to hit $1 trillion by 2025. Think about that for a moment. $1 trillion. That is a huge amount of money. And just to visualize that, this is what it represents if you were standing up against it. Okay, so before we know whether or not Australia is safe, let's unpack what's happened in Russia and see whether it's likely to pass on over to Australia. So we start off with trying to understand what a key rate is. So we can see here that the key rate is the interest rate at which a bank can borrow when they fall short of the required reserves. And in short, the key rate is much the same as Australia's cash rate. Now, the next question is, why is it increasing? Well, it's for a number of reasons. The first is the ruble, and essentially that's Russia's currency. And what we can see here is that it's crashing. And this is one of the reasons why Russia had to increase their key rate. The next reason is Russia has a bank run. Essentially, people lining up in long queues to take all their money out of the banks. And if this wasn't bad enough, investors and big corporations are taking all their investments out of the country. And the final nail in the coffin for Russia are the international sanctions, which is essentially suffocating the economy. And as you can tell by now, things financially aren't looking so great for Russia. And the Bank of Russia have explained why they've made this decision. Essentially, it's saying that the Bank of Russia's board of directors have decided to increase the key rate to 20% per annum from the 28th of February 2022. External conditions for the Russian economy have drastically changed. The increase of the key rate will ensure a rise in deposit rates to the level needed to compensate for the increased depreciation and inflation risks. And this is needed to support financial and price stability to protect the savings of citizens from depreciation. What the Bank of Russia is essentially saying is that inflation's out of control. And back on their website, we can see that the inflationary target of 4% is way off. At the moment, from January 2022, it's 8.7%. And for the Russian economy, inflation has been increasing since April 2021. And what we can see here is that it's been gradual and increasing ever since. With Russia importing almost $240 billion worth of goods each year, it means that for its two biggest importers, China and Germany, everything's gotten a hell of a lot more expensive. Because without intervention, hyperinflation could be a real issue. And if we look at history with what hyperinflation looks like, we can look at the old German mark. Comparing to what the Russian ruble is doing compared to gold, it seems like there's a bit of a pattern. And with everything going wrong with Russia, is it any wonder why the Russians had to increase the key rate? And by now you can definitely agree why they took evasive action. So now, what does this actually mean for Australia? Firstly, having a look at what our trading relationship with Russia is will be a great start. So looking at it, we can see that Russia was Australia's 46th largest trading partner in 2019, with the trade balance strongly favoring Australia. Looking at what that actually means, we can see that the merchandise exports of Australia was about 655 million, with 106 million also in service exports. Looking at that in more detail, we can see that the exports to the Russian Federation in 2019 was way more in favor of Australia than the import. And with Australia exporting a total of $284 billion in 2019 and importing a total of $209 billion, it means that the economic impacts, both imports and exports to Russia, are small in comparison to the total imports and exports. And with Australia having an inflation target of between 2 and 3%, with the current inflation at 3.5%, you can see that we're in a very different position. Firstly, we don't have any war, no sanctions, and our inflation is definitely within the range of expectations. And if you are worried about rates rising, there are a few things you can do. Firstly, look at fixed rates. That'll mean that your interest rate won't change in the fixed period. The next thing you want to do is close down all unnecessary debt. So whether it's a credit card or a car loan, look to clear as much debt as you can so that you're prepared for if rates do rise. The next step is keep track of all your expenses. Looking at those recurring bills such as gym memberships, if you haven't used them for a while, a great reason and a great way to save some money. And finally, as the saying goes, proper prior planning prevents poor performance. And how you do this is by adding a buffer to your payment. So for example, if your current rate is 3%, add 2% and make your payments on a 5% interest rate. In this way, you'll know what to do to trim around the belt to be prepared for those rate rises if and when they do happen. Here at Hunter Galloway, we get home loans approved. If you live in Australia and looking for a mortgage broker, we can help. We service Australia-wide and there's no fee for our service. So visit us online at huntergalloway.com.au or call us on 1300 088 065. Thanks for watching, and I'll catch you next time.